three critical parts to the financial statements. The actual report, so the notice to reader report, compilation engagement report, they're being called. There's a few changes in the way CPA Canada is having things named. We won't dive too deep into that. It's not fully implemented yet, but you're going to have a report essentially saying a CPA firm, an accountant has prepared these, what they're for, who they're for, what they're for. And then you're going to be the two most important statements, like Matt just previously said, balance sheet and your income statement. Those are the two staples. They're always going to be there. There's a couple additions. Sometimes there's notes to the financial statements, possibly a cash flow statement, but definitely not required. But yeah, balance sheet. And here's a quick snapshot. They're all mini, but you can get an idea. If you've seen financial statements from us, you've probably seen something that looks very, very similar. So notice to reader report, income statement, balance sheet, containing the total of that fiscal year. Just the trial balance we're showing you. What's this? Are we highlighting?
Yeah, this is just to highlight the balances that were adjusted, and yeah, this really ties, all these account balances tie to the financial statement balances that are in here. So it's really just reformatting this into the two different statements. Okay, I can talk about how, so this has all the accounts that are in the financial statements, but you can basically draw a line right here between income tax expense and bank. The top portion is the income statement, the bottom portion is the balance sheet. And the balance sheet is really, it's on your year end, on January 31st, these are all the balances of things your company owes or owns. So cash balance on January 31st, that should be that's a fixed number. There's no time, or there's no activity being recorded on there. The income statement is where all the activity in the 12 months of the year, all the activity that your company transacted on. So that's all the revenue, all the expenses are captured on the income statement, and then at the end of the year, sum it all up. What's the effect on different balance sheet accounts? And the two, as the word balance in balance sheet implies, the two connect to each other through the net income and the retained earnings. So that's how assets need to equal the sum of liabilities and equity, and you got to put net income in there as well. So it all has to work together.
The big key is that you can never actually have one without the other. So you're always going to need your income statement, and it's going to roll into your balance sheet. And if you continue going further, you would need all that to roll into your cash flow statement. So all of the financial statements, you need them, and they work together, and that's how this all goes.